Good morning, everyone. Thank you for joining us. I'm pleased to introduce today's host, Kevin Mullen. Kevin is a market strategist at MFS Fund Distributors, a subsidiary of MFS Investment Management. He brings over 20 years of experience at MFS with deep expertise in capital markets, macroeconomic trends, and multi-asset investment strategies. Kevin holds both a CFA and a CIMA designation and regularly shares his insights with clients across North America. We're thrilled to have you today, Kevin, and I'll turn it over to you.
Great. Well, thanks for having us here. Thanks everyone for jumping on. There's clearly a lot going on in the world. There's a lot we can talk about here and a lot that I'm going to try to put into perspective in about 15, 20 minutes or so. And I view this as your time. So I want to make sure that when this discussion ends, you can walk away feeling a little bit better about the world we're in, the direction, the future, financial situations, and hopefully have a few anecdotes or stories that you can pass along and share to um, friends, spouses, or whomever. We're going to try to also give you a framework to think about all of the headlines and information that's constantly getting thrown at you. And hopefully definitely leave some time for questions at the end. So there's a lot of indexes out there. I'm sure we pay a lot of attention to things like the Dow Jones Industrial Average, the S&P 500, and so on and so forth. But there's basically an index these days to measure everything under the sun. And over the last few months, there's one that I'll be honest, I had never really heard of or paid much attention to until earlier this year. And it's called the Economic Policy Uncertainty Index. And the reason I'm mentioning this specific index is because it began to skyrocket um, in early April or so as we approach Liberation Day. And it's basically a measure of uncertainty for the public. And we got up to a level in early May, or excuse me, early April, that was the second highest level in history behind that of only what we experienced during the COVID-19 pandemic. And then, believe it or not, just about a week or two after that, we surpassed that level and it became the highest level of economic policy uncertainty ever. And I just kind of like to mention that because I always ask the crowd or the audience to say, does it feel to you or anyone on this call like it did uh, during COVID, where millions of people were dying? I had to wear a mask riding the subway in Boston if I was allowed to ride the subway. I wasn't supposed to be going into the office. My nephew was learning from home, and so on and so forth. But that is the level of uncertainty that the market is pricing to what we've experienced over the last couple of months. And I think that's, I'll just use the word interesting, for probably a lack of a better term. But that goes to show you um, how overblown the market and the media can make certain things out there, and why we need to work with the professionals to keep these things into perspective. And we need to take these readings and these indicators and the headlines with not just a grain of salt. A lot of times you need to take them with an entire salt shaker. Um, but as you just as a aside there, if you look back throughout history, when an index like that, I mentioned the Economic Policy Uncertainty Index peaks, we can look back at the data and say, what has the stock market traditionally done over the 12 months following a peak? And I used to not even mention the number because I didn't want to set the wrong expectation. But we've already made back 26% since the last peak. So I no longer fearful mentioning the number, but it's actually an average return over the next 12 months of 33% for the S&P 500. Now, as you can imagine, when the market was down, and I was like, I don't feel comfortable mentioning a 33% rebound. But then you blink your eyes, and a few weeks later, we're up 26% from the April 8th lows. So it's pretty wild. It's pretty amazing, and I again, one of the reasons I use this index as an example, and there's a boatload that I could reference that all show the same thing. You can look at them almost as contrarian indicators. The pendulum swings, and it always swings too far to one way or the other. And then over time, it slowly works its way back as emotions come down a little bit, and water tends to always find its level ground. So I like to start off my calls just by mentioning that, and believe, as you would imagine, that index is starting to creep up again as the tariff headlines are beginning to take hold of the news once again. But of course, I don't know what the market is going to hold in the future. None of us do. But one thing I can tell you is that every single pullback or downturn the market has had, it's made back 100% of those losses and always moved on to reach a new market high. In fact, that low that we saw on August 8th, it took a record-breaking 55 trading days for the market to get back to a new all-time high, which it achieved on June 27th. And then it's been making new highs since then. But that's the fastest you've ever seen a round trip for the S&P 500 after a pullback of at least 15%. So we're breaking all sorts of records now. And while I don't know again what the market's going to do in the future, I can tell you that whatever's coming at us, we're going to be entering from a relative position of strength. And I'm going to share just a few data points with you that you might not see on the news, or you might not get the full story, depending on what headlines you're watching, what websites you're reading. But there was supposed to be a lot of inflation coming out. And actually, there was an inflation number this morning, which I haven't seen yet because it came out about 10 minutes ago. But
Yeah.
we're all waiting for a big, big, big inflation spike starting probably 2 months ago. And guess what? The spike hadn't happened. Um, it actually, we saw inflation numbers come down for the first time in a couple of years. Now, there are a few reasons for that, right? One of the big ones was energy and oil prices have come down, which is one of the things that the administration ran on. But sure, you can find inflation in certain areas if you look, but overall, in aggregate, prices had started to come down, and energy and oil is a big, big component of that. Lower gas prices gives people more discretionary disposable income, more money in their pocket they can spend on other things. We did see a hiccup there when there was a conflict with Iran a few weeks ago. So that threw a little bit of a wrench into the plans, but with a blink of an eye, that seems like it's almost a forgotten thing right now. Amazing as it can be. Um, and the consumer is still very strong. We get retail sales data, consumer spending data, um, and the flashing red light doesn't seem to be flashing. And based on the news headlines from probably starting 2 months ago, 3 months ago, you would have thought we'd be in a real difficult situation right now. And we're just not seeing it. The job market is something we watch very closely. The first Friday of every month, we get a non-farm payroll number. It's how many jobs were added. We watch that very closely. And the number that came out on July 3rd, people were, were very nervous. They thought the number was going to be very bad. And lo and behold, it was really darn good. And people were scratching their heads trying to poke holes in it. It wasn't perfect, but it wasn't even remotely close to bad or benign. It was actually pretty good. And we also get a weekly initial jobless claims number. And last week, it had actually came down a little bit, so less people filing for unemployment. So things are still chugging along. And if people have jobs, we're a nation of consumers, so we're going to keep spending. And we keep spending, companies keep making money, and they keep hiring, paying dividends, their share prices go up. The consumer makes up 70% of the US economy. So jobs are obviously very important. Now, everyone loves to talk about Trump and the administration. So I'm going to give you a little bit of a framework, to kind of the second half of the call here, which I think if you just envision this in your mind, no matter what headline you get thrown at you, you can compartmentalize it and say, okay, is this something I would consider good, bad, and what is the overall weight? How important is this thing? So the best way to do this, in my opinion, is to almost envision a seesaw. And on one side of the seesaw, we're going to imagine things that are not that good. Okay, not that great. Negative things. So like a thumbs down. And that would be anything that can slow down growth. That would be anything that can cause inflation because inflation is bad. There was going to be two main items on this side. One of them we haven't talked much about. It's not on the news that much. Headlines pop up. I'm sure they will be coming up again, but that would be mass deportations. If the administration removes millions and millions of people from the country, sure, there could be a labor shortage, and the people that are left here will demand higher wages, and that causes wage inflation. Again, inflation is a bad thing. So we want to keep inflation down. So if we see mass deportations, that's something that could cause concern. Not an issue right now, but this stuff can change in the blink of an eye. So keep that in the back of your mind. The main issue on this side of the seesaw is tariffs, something we've been talking about for months now. It was kind of put on the back burner for a little bit because we were in a 90-day pause period that was supposed to end on July 9th. It's now been pushed out to August 1st. Basically, the administration wants to give some more time to have an agreement, to make an agreement down the road, because these things do take a very long time. And I mean, we're starting to see it. We've seen it with Europe. We've seen it with, excuse me, we've seen it with um, UK, China. Things moving along. We saw something come out with Vietnam, making progress with Europe, and even discussions with India and China. These things will take time, no doubt. And what you're going to end up seeing is agreements to have an agreement down the road. There's also what's called sectorial tariffs. Okay, and just think of the word sector, sectorial. And those are tariffs that are put on to sectors like autos, auto parts, steel, aluminum are the big ones that we already see right now. And in the works, there's things on semiconductors and pharmaceuticals. But a lot of these things can be viewed as negotiation tactics. Um, and at the end of the day, what you're probably going to see is right now, basically been a blanket 10% universal tariff. As we can learn from the experience that we saw with Vietnam, tariffs are probably going up from that 10% level, but they may not be as bad as what was originally proposed on Liberation Day, where Vietnam had a 46% tariff. They went down to 10% and they landed currently at 20. Okay, so that's what we're thinking. This is very fluid. This changes not even day to day, sometimes hour to hour, but that's something we're watching. And this is going to generate revenue to help lower the budget deficit and to pay for some of the tax extensions, which are a few of the items that we're going to talk to next as we move to the other side of the seesaw. So what I want you to think about is there enough good stuff out there, things that are in the pipeline to offset these potential inflationary forces, these potentially headwinds to growth? And I think the answer is, absolutely. We don't know the magnitude and they will change over time, but there's four items on the other side of the seesaw. Again, on the thumbs down side, mass deportations and tariffs. Tariffs are the big one right now. On the other side, okay, I want you to think of lower energy, lower oil prices. That's something we've already seen. We've already mentioned that. That's very important. You have lower energy prices, you're going to keep inflation down. You start to get inflation to come down, the Federal Reserve can finally potentially lower interest rates. Interest rates comes down, that means the US government can pay less on their debt, which the debt burden on the United States right now, as you know, it's massive, the largest it's ever been, larger than our defense budget. We need that to come down. One of the best ways to do that is to pay a lower interest rate on that. So we need rates to come down. That's in the works. That's happening. So lower energy prices, we got that one. Smaller government slash Doge. That's a little tricky. Um, Anything that can be done, look, the Doge wasn't going to come in and cut trillions of dollars in taxes, but anything that can be done to chip away at the size of government overall helps the private sector. You go back to some of your economics books, it was called the crowding out theory. It allows more resources for the private sector, which tends to operate more efficiently, increase potential GDP, increase living standards, and that ultimately helps keep inflation down, prices down as it increases productivity. So that's happening. Federal spending has been chipped away at. There's a lot more work to do to get the budget deficit down. And then the last two are the big ones. Taxes, TCJA slash OBBB, the one big beautiful bill. That is the one that Congress was working on when tariffs were rolled out. I like to say tariffs are spinach. No one likes the spinach. They know they need to offset and give some candy. So the tariffs were the spinach. They said, hey, we got to get something good through Congress. We need some tax breaks. OBBB, one big beautiful bill. That's going to be the candy to hopefully sterilize the negativity that's going to come out on the tariff side of this seesaw. And that's kind of what we're seeing. The 2017 tax cuts have been extended for individuals, which is a massive thing. Would have been about $400 billion. Suddenly, the U.S. Consumer would have to start paying. So those got extended. That's great. We're also seeing some additional campaign promises got fulfilled. Things like no taxes on tips for certain amounts. There's been a couple items added to Social Security. Taxes on overtime, things like that. Those aren't really going to move the needle overall. They're going to help certain individuals. The scheme of the overall big picture, not really going to move the needle, but one of the big items is for corporations, what we call 100% expensing of factories, property, plant, and equipment, research and development, software. So if I was to build a factory, current, I should say, last year, if I was to build a factory, I would hold that on my balance sheet and depreciate that asset over 39 years. Great. I get a little bit of a write-off every year. Fantastic. Straight line depreciation. Now, 100% expensing means you're going to pull all 39 years of those write-offs and get them all in the first year. A big boost to those companies. And ultimately, that's supposed to be a big incentive for corporations to bring manufacturing back to the United States and create jobs. There's been a lot of companies, tech, pharmaceuticals, autos that have already committed billions. There's an AI conference this week, where Trump is, I think, if it didn't happen last night, it's today, where he's announcing about 70 billion in investments in the state of Pennsylvania. And that's what this is all about. Because for every one manufacturing job that's created, there's a trickle down effect, and that creates seven non-manufacturing jobs. So potentially a big boost to the U.S. economy. Um, we will see how that pans out, but that's something that investors are fairly excited about. And the last item would be deregulation. Can be tricky. You can't just remove all regulation out there. You could have something like the great global financial crisis that we saw in '08 and '09. Regulators are aware of that, but there's a lot of regulation out there that is a major financial burden on corporate America. And there's certain pockets of the market that will benefit greatly, particular financials, utilities, as deregulation is being removed. And these things take a little bit of time to work their way through this beast of a system that we have, but we're already starting to see it. And it's supposed to really start to show through starting in Q3 and Q4, mainly with financial deregulation, improving lending, merger and acquisition, things like that. So we will see there's a lot in the pipeline that can offset some of the negative headlines. So when you read about something on the news, or when you think about, okay, what side is this going to be on? Is this going to be something that can slow down growth and cause inflation, or is it something that maybe a boost to growth that could lower inflation? And that's kind of a framework, and that's what we're going to see. We just need to make sure we have enough offsets to keep the economy going. And as of right now, things are looking pretty good, and we're pretty excited about the future. So with that, I'll just do a time check. I just went about 20 minutes. which is way longer than I like to speak. So I'll turn it back to you and see if there's any questions.
Yeah. Yeah, I mean, overall, it sounds like you guys are pretty bullish on, on the prospects of the market. Are there any areas that concern you? I know, the people on the other side of the bill say that, hey, it's going to increase the deficit and ultimately push up inflation. Um, you know, how do you guys, write that? I mean, is what would push it up higher? What are some concerning points? Maybe walk us through the other narrative of what would concern you and maybe change your thesis point on, where the market's going and its overall direction.
Sure. Well, I haven't seen the CPI number this morning yet, but I'm guessing it probably started to come up a little bit.
Yeah, 2.9. Yep.
Well, perfect. I think the expectation was 2.8, so 2.9. We were kind of thinking we'd see that. That's going to happen as it takes a little bit of time for the inventory to burn off. So, just to explain to some of the people on the call, if you look at something like GDP, GDP really got thrown off in Q1 because companies, they knew what was coming down the road. They knew that their cost of goods was going to be increasing because of tariffs. So what they did is they had a massive pull forward of inventories. Inventories increased a record 51% at the end of Q1, and one of the inputs to GDP is net exports. So that number really, you had to throw out GDP in Q1. It was totally skewed. But then the flip side of that is there's going to be a major reversal in Q2, which is also what we saw. So you have to throw those numbers out and you have to kind of wait and see, okay, I need to get some clean data. When am I going to get clean data that I can hang my hat on? And that's something the Federal Reserve is watching for. Probably going to start to see that in Q3, which really won't be reported till Q4. So that's one of the reasons why people are saying, I don't know if I think the Fed will make any cuts in, people were talking July. Don't think so. Maybe September, potentially. I think we need to wait and see until we get some better data. So I'd be watching two main things again. The inflation number, sure, probably going to spike here. Then we'll see it start to come down as we talked about inventory, the consumer, the economic policy uncertainty index. These things are all, as the uncertainty goes up, consumer will probably tighten their belt a little bit, wait for some more clarity. But also, I would continue to watch unemployment. If unemployment started to spike, I'd start to get a little bit worried. Um, and also, we're going to see a ramp here in fiscal spending that's going to last for a few quarters, and that's supposed to come down. And I'd keep an eye on what we call the yield curve, the 30-year right now. I can probably wait, I'd probably watch and continue to see that move up. There's a few reasons why the 30-year part of the yield curve, I don't want to get into it too much, can move up. Some of them can be for good reasons if there's major growth expectations, but some of them, as we've seen lately, can be for not so good of reasons, like spending and the budget is getting out of control. If I'm going to lend the US government money for 30 years, I need to be paid a lot to do that because I am so nervous and so worried about the state of the United States finances. Then that's why that end of the curve would go up, because the riskier a loan is, the more you need to be compensated for lending someone that money. So those are a couple of things I would be watching. The way the CBO has it right now is based on current policy, not current law, that the tariffs should more than offset the spending from the OBBB. Time will tell. The numbers changing constantly as we're seeing the how can you do one side of that calculus when you don't even know what the tariffs are going to be? We see 35, we see 30. So it's we're not going to know this stuff for a long time. So there are a lot of concerns and there is a lot of uncertainty. But the U.S. consumer is just, and the U.S. Markets in general are just so darn resilient. Everything I've seen, whether it was COVID, post-COVID, the GFC, we seem to find a way to figure it out. So I'm watching, I'm optimistic, and I think we'll find our way through this. And, there are other investments outside of the United States as well. which obviously I don't need to talk about too much here, but there are parts of the globe right now that have been doing significantly better than the United States on a year-to-date basis, and that's why we diversify. That's why we own stocks and mutual funds that are called global or international, because there are more companies located outside the United States than inside the United States. And there's a major, major diversification benefit to that. And if you look at your statements or some of your funds, the way they performed this year, the ones that are outside the US have done most likely significantly better than the ones inside the US, at least through the first two quarters. Um,
Do you think that's good? Do you guys project that to continue? Obviously, there's some opportunities to push some of those markets in Europe higher, but how are you guys kind of broadly viewing international markets?
I'm trying to set expectations and be very honest with people because let's face it, non-US markets ripped, and they ripped basically the first 2.5 months of this year. In June, even in Q2, non-US outperformed US, but only by about 100 basis points. So a majority, almost all of that excess return came from Q1. In June alone, S&P doubled the MSCI EFA. So I think you're going to start to that outperformance you saw in the first quarter, that's not going to continue. That that gap will begin to narrow as US plays catch up. But we do think that there's opportunities more so now than in the past for things you mentioned, whether it's um, uh, spending reforms in Germany and stimulus in parts of Europe, or structural reforms in Japan or even China. We're telling people that have been, uh, for lack of a better term, hating on international for a decade. Now's the time, if you haven't already, to close that underweight. So
Mhm.
that's how I'm positioning it. I'm not saying go 25 or 30% and do some massive overweight. I'm saying it's definitely time, if you haven't already, at least cut that underweight position down a little bit and start to take a closer look. And there are certain pockets that will do better than others.
Anything in particular maybe you would highlight there? Whether it be, Europe, India, China, anything in particular that you guys really like?
I would continue to take a close look at parts of Japan. Major structural reform there, governance, paying more attention to shareholders with share buybacks, uh, div payout ratios, things that have helped U.S. companies for so long. Finally, the Tokyo Stock Exchange and um, regulators there said you need to improve your price to book ratios, you need to increase your ROE, and they even went to the length of saying, if you do not do this, you will be delisted from the Tokyo Stock Exchange. Let's try to put that into perspective. Let's say the S&P 500 went to Johnson Johnson, General Electric, and Ford and say, hey, if you guys don't do X, you're going to be delisted.
Yeah.
That's a pretty strong statement. And guess what? They weren't just messing around. They kicked off 84 companies last year. And I love it. I love to see it because you know what? If you're going to try to have some major reforms in your country and put down laws and rules, you might have to make an example of some companies that don't choose to play by those rules. I mean, granted, there's 1,000, I think 2,000 companies on that stock exchange, so there's still a lot of great names out there. Maybe it wasn't that many, but at least they made an example out of 84 companies that did not improve their return equity. Were viewed as not treating their shareholders the way they should going forward. And if they right that ship, I'm sure they'll be added back. But major reforms there. China, I think the bar is a little bit higher. What we need to see there, they still have a boatload of issues with demographics and housing, but they are, I think I read yesterday, they about 10% of their GDP is what they're rolling out in stimulus right now. So I think there's opportunities there. That is something I would view more as a trade than a long-term investment.
Yeah.
Is the volatility there is just through the roof. But certain sectors here in the US that can benefit from deregulation, onshoring, financials, utilities, industrials, and no coincidence, those are some of the best performing sectors year to date.
Any Any thoughts maybe on the alternative space? I know I get this question all the time, with the meteoric ride of rise of like the crypto space. How do you guys, think about that when it comes to just general inclusion in models into the future? Do you guys see that becoming more adopted? And, how do you guys kind of think about the asset allocation side?
Yeah, I mean, look, we're a bottom-up traditional
Yeah.
boring long only shop for the most part. We don't play in that space, but I'll be honest, just because we don't play in something, I'm not going to be, that pig-headed to say you don't need to own it. I think there's absolutely a place in a portfolio for gold. Look at what's going on with copper, crypto. I don't understand it. I don't know how to value it, but does it mean that it is not a good diversifier to a portfolio? The correlation is very low to other investments. So I think there could be a piece to that. We just don't play in that space. When it comes to privates, this is very interesting. If you look at privates versus the S&P, there's a State Street index that it measures the privates in aggregate. The S&P has actually outperformed that index over pretty much every time period. So, with liquidity concerns and things like that, I don't want to have the argument with someone about privates. There's some great opportunities there, but I don't really see the massive need for it unless we still see more and more companies continue to fall out of the public space. But, own it. We just don't really have much in that space.
No, thank you. I had one question come in, and as we finish up, guys, here, if anyone wants to send any additional questions you want to ask here for Kevin, feel free. I had one just asked if there was anything in particular in the Big Beautiful Bill that is favorable to small businesses. I don't know if you know anything about that from an offhand standpoint.
Um, I mean,
Because I know it's a pretty lengthy bill, so I didn't want to hold your foot to the fire on that one.
yeah, the major aspects of that bill, I think, is what we've already covered, and some of them would be the expensing provisions. That will be somewhat of a rising tide that can lift all boats because of the second and third derivative effect of these companies coming back here. As I mentioned, you'll see manufacturing jobs come back. For every one manufacturing job, there's seven non-manufacturing jobs. Those other non-manufacturing jobs will be small business jobs. I'll give you a real world example. Well, two examples, and it's great because it relates to my own life here. So my fiance is a Johnson& and Johnson engineer. At parts of her career, she worked in factories. She has her MBA. It's no longer the factories you think of, these mills where people just shoveling coal, and they have very skilled machinists in these factories. So these are some higher skilled jobs that also require not just the machinists, as I mentioned, engineers have to be on site. You have supply chain, procurement teams, you have management, you have janitors, right? My college roommate, Michael Sullivan, he had a family business called Saltec. Okay, this would be a small business. They sold chemicals to factories throughout Massachusetts to help clean their equipment. This was pre-COVID. They were chugging along, doing great. I think they became multimillionaires during COVID. Okay. So that's the type of thing that you think about a small business, a father and a son and two other friends selling chemicals to clean these factories. That's small business at its finest. The coffee shops, the daycare centers, the repair people. Those are all small businesses. They will all thrive as well. So that's how we need to kind of think about this. It's the the housing sector. There's a huge multiplier effect there, but the same thing with manufacturing as well. And I think that's what we're going to see.
Well, I think for folks on the call, it makes you feel pretty good when you go through the analysis at this level, and and some of the prospects for growth into the future. So with that, Kevin, I definitely wanted to say thank you for the time today and the information, and then thank everyone who for joining today. If you guys do have any questions as far as follow up, please don't hesitate to reach out to me. MFS is a great partner, and we can certainly lean on their research into the future. So with that, thank everyone and hope everyone has a wonderful morning. Take care.
Take care. Thank you. Bye now.